When I study markets, I try to focus on the forces that are quietly shaping future outcomes rather than the headlines that dominate attention today. Most investors spend their time watching prices move up and down, but price is usually the final expression of deeper structural changes that have been developing for years. By the time those changes become obvious, much of the opportunity has already disappeared. Today, when I look at silver, I see a market that is approaching a potentially important turning point, not because of speculation, not because of a temporary trend, and not because of social media excitement, but because several powerful forces are converging in the same market at the same time. Throughout history, some of the biggest moves in financial markets have occurred when structural realities diverged significantly from public perception. In my view, silver may be one of those situations. To understand why, we first need to understand what silver actually is. Most people think of silver as simply another precious metal. They place it in the same category as gold and assume its value comes primarily from investor demand. While there is some truth to that idea, it misses what makes silver unique. Silver is both a monetary metal and an industrial metal. For thousands of years, civilizations used silver as money. It stored value, facilitated trade, and served as a trusted medium of exchange. At the same time, silver possesses physical properties that make it one of the most useful industrial materials ever discovered. It is the most electrically conductive metal known. It is highly reflective. It is resistant to corrosion. These characteristics make it essential for a wide range of modern technologies. This dual identity means silver benefits from two separate sources of demand. One comes from investors seeking protection against monetary instability, and the other comes from industries that require physical silver, regardless of investment sentiment. When analyzing silver, one of the most important distinctions investors need to understand is the difference between the paper market and the physical market. Most people believe there is only one silver market because they see a single quoted price on financial news networks and trading platforms. In reality, there are two interconnected but distinct markets. The first is the paper market, where futures contracts, options, exchange-traded products, and various financial instruments trade every day. The second is the physical market, where actual silver bars, coins, and industrial inventories exist. During normal conditions, these markets move together, which leads many investors to assume they are effectively the same thing. However, history shows that they are only equivalent as long as market participants continue treating paper claims as substitutes for physical ownership. For decades, the silver market has relied on this assumption. Most traders never intend to take delivery of physical silver. They simply want exposure to price movements. Contracts are rolled forward, positions are settled financially, and the system functions efficiently as long as demand for physical delivery remains relatively small. The paper market can operate with enormous leverage relative to available inventories. This structure has existed for years and is considered normal by market participants. But when I study financial history, I repeatedly encounter the same lesson. Systems that appear stable often depend on assumptions that are invisible until they are challenged. When enough participants begin wanting the underlying asset instead of financial exposure, the distinction between ownership and exposure becomes extremely important. We saw signs of this during periods when demand for physical silver surged. Dealers experienced shortages, premiums rose dramatically, and delivery times increased, while the quoted paper price remained relatively stable. The physical market was signaling that actual silver was becoming harder to acquire. These events were temporary, but they demonstrated something important. Paper silver and physical silver are not necessarily identical under all circumstances. During periods of stress, they can behave differently. Most investors ignore this distinction because normal conditions make it appear irrelevant. History suggests that distinctions which seem irrelevant during stability often become critical during periods of change. At the same time, the industrial demand picture for silver has become increasingly compelling. One of the largest drivers of demand today is the global expansion of solar energy. Modern solar panels require silver because of its unmatched electrical conductivity. Engineers have spent years attempting to reduce silver usage and develop alternatives, but completely replacing silver without sacrificing performance remains difficult. As countries invest heavily in renewable energy infrastructure, silver consumption from solar manufacturing continues growing. This is not a short-term trend. It is part of a multi-decade transformation of global energy systems. The world is committing trillions of dollars to energy transition projects, and silver remains an essential component of that process. Artificial intelligence infrastructure represents another important source of demand. The growth of AI requires enormous amounts of computing power. Massive data centers are being built around the world to support machine learning systems, cloud computing, and advanced analytics. These facilities depend on sophisticated electrical systems, networking equipment, and semiconductor technologies. Silver plays an important role in many of these applications because of its superior conductivity and reliability. While investors often focus on software companies when discussing artificial intelligence, the physical infrastructure supporting these technologies also requires strategic resources. Silver is increasingly becoming one of those resources. The expansion of electric vehicles adds another layer to the demand story. Electric vehicles contain significantly more silver than traditional internal combustion vehicles. Advanced electronics, battery management systems, sensors, connectivity technologies, and charging infrastructure all require conductive materials. As governments and manufacturers continue investing heavily in transportation, electrification, silver demand from this sector is likely to remain strong. What makes this particularly interesting is that solar energy, artificial intelligence infrastructure, and electric vehicles are all growing simultaneously. Each trend independently increases silver consumption. Together, they create a powerful structural demand backdrop. Supply, however, does not respond as quickly as demand. Mining is a complex and capital-intensive industry. Discovering new deposits takes time. Developing mines takes time. Obtaining permits takes time. Building infrastructure takes time. Even when higher prices encourage investment, meaningful increases in production often require many years. This creates a situation where demand can rise much faster than supply. Commodity markets have always resolved these imbalances through price. When demand exceeds available supply, prices eventually increase until new production becomes economically viable or demand adjusts. This process has repeated itself throughout history across countless commodities. Silver is not exempt from these economic realities. Beyond industrial demand, the monetary case for silver remains significant. Throughout history, periods of excessive debt, accumulation, and monetary expansion have increased interest in hard assets. Governments around the world carry historically high debt burdens. Central banks have expanded their balance sheets dramatically. Over the past 2 decades, policymakers face difficult trade-offs between supporting economic growth, maintaining financial stability, and preserving purchasing power. Whenever confidence in paper assets weakens, investors often seek alternatives that cannot be created through policy decisions. Gold has traditionally been the primary beneficiary of this behavior, but silver has historically participated in the same trend. What makes silver different from many other assets is that it does not depend entirely on one narrative. If concerns about inflation increase, silver may benefit from its monetary role. If industrial demand continues expanding, silver may benefit from its industrial role. If both forces strengthen simultaneously, silver benefits from both. This dual demand structure creates a unique dynamic. Most assets depend on a single dominant source of demand. Silver draws strength from multiple directions. When several powerful trends align, the resulting impact can be greater than most investors anticipate. Investor psychology also plays an important role. Human beings naturally focus on recent experiences. If an asset has disappointed investors for years, many assume it will continue disappointing them. This tendency causes people to overlook improving fundamentals. Silver has spent long periods consolidating and frustrating market participants. As a result, many investors have lost interest. Ironically, this lack of enthusiasm may be one of the reasons the opportunity remains attractive. Markets often provide their greatest opportunities when public attention is elsewhere. By the time a compelling narrative becomes widely accepted, prices have usually adjusted significantly. History provides valuable lessons in this regard. Major market moves rarely occur when everyone expects them. They typically occur after long periods during which structural conditions improve while sentiment remains indifferent or negative. During those periods, patient investors accumulate positions based on fundamentals rather than headlines. Eventually, the market recognizes what has been changing beneath the surface, and prices adjust accordingly. While every cycle is different, the underlying pattern remains remarkably consistent across asset classes and generations. Another important consideration is portfolio construction. Successful investing is not about making extreme predictions or placing all of one's capital behind a single outcome. It is about understanding probabilities and building resilience across different scenarios. Silver should be viewed through that lens. The case for silver is not based on certainty. It is based on the observation that multiple structural forces appear favorable simultaneously. Investors should always consider risk management, diversification, and position sizing. However, they should also recognize when market conditions create opportunities that are not fully reflected in prevailing expectations. One of the most overlooked aspects of investing is understanding exactly what you own. Many investors focus exclusively on potential returns, while paying little attention to the structure of their holdings. During stable periods, this may not matter very much. During periods of market stress, it can matter a great deal. Investors who own physical silver possess a tangible asset that exists outside the financial system. Investors who own paper instruments possess claims whose performance depends on the structure of those instruments. Neither approach is inherently right or wrong. The important point is understanding the distinction and aligning ownership structure with investment objectives. When I evaluate silver today, I see a market influenced by powerful monetary forces, powerful industrial forces, and significant supply constraints. One sees growing demand from renewable energy, artificial intelligence infrastructure, advanced electronics, and electric vehicles. I see a world characterized by high debt levels, ongoing monetary challenges, and increasing interest in hard assets. One sees a market that remains relatively underrepresented in many portfolios, despite improving fundamentals. Most importantly, I see conditions that resemble the early stages of other important market transitions throughout history. Of course, no one can predict the future with certainty. Markets are influenced by countless variables, and outcomes rarely unfold exactly as expected. Economic growth could slow. Technological developments could alter demand patterns. Policy decisions could affect investment flows. These uncertainties are real and should never be ignored. Successful investing requires humility as much as conviction. The objective is not to know the future. The objective is to understand the forces shaping possible outcomes and position intelligently in response. Ultimately, the reason silver deserves attention is not because of a specific price target or a dramatic forecast. It deserves attention because it sits at the intersection of some of the most important economic and technological trends of our time. It is a monetary asset in a world of expanding debt. It is an industrial asset in a world of accelerating technological development. It is a finite resource facing growing demand from multiple directions. These realities do not guarantee a particular outcome, but they create conditions that investors should not ignore. When I study markets, I look for situations where structural trends are stronger than prevailing narratives. Silver appears to be one of those situations. Whether the adjustment occurs gradually or rapidly remains uncertain. What matters is recognizing that the forces driving the market are becoming increasingly powerful. Investors who understand those forces will be better prepared than those who focus only on short-term price movements. In the end, wealth is often built and preserved not by reacting to what everyone already knows, but by identifying important changes before they become obvious to the crowd.